Jordan, let me show the photograph right now. This is a Bloomberg. This is one way to look at a given spike or surge. This is 2 standard deviations of vol on Euro Swissy. Notice how these previous days have well-contained trading. Okay, there's one that's barely moved. Look at this. Here's this massive move, weaker Swiss franc, stronger euro for a cup of coffee. Not even that, for 2 sips of coffee as well. Jordan Rochester, I don't believe this is a flash crash. If it's not, what is it?
It's a fat finger, Tom. So a fat finger trade where it seems like during the overnight markets, like when Auckland opens up, when it's Sydney hours, that's when you have very low liquidity, but the electronic markets we now work in do have this sort of facade of liquidity. So you see 2 prices on the screen, but the amount of volume you can get done with those prices is very little. So you probably saw one big trade selling Swissy, a normal trade for London hours, but outside of London hours, low liquidity, big moves. And the fact we moved so quickly back to where we were before that price went through tells you it was a fat finger trade.
I don't disagree. Does it harm anyone? Is there a so what here? I mean, are trades cleared out? Are they stopped out because of a fat finger?
In essence, yes. Actually, the days when I see fat finger trades, this is a small one versus the likes of ones we've seen in the pound, for example, or dollar yen at the early beginning of this year. Yeah, if you had 3 consecutive ticks through a level, that tends to trigger what we call option barriers. And so people's options trigger in, good for them, but a lot of others, they trigger out, bad for those. So these big moves on the back of very little, it's frustrating for us in the markets, and we need to work towards this in the FX codes of practice to somehow stop these big flash crashes. But so far, we're seeing more of them than less. In terms of frequency of flash crashes, remember 2010, we had the big flash crash in the Dow Jones. Then we didn't see any for a while, but now they seem to be happening every couple of months. Turkey's another example, for example.
So Jordan, flash crash or not, will the Swiss upside be kept, limited by the S&B?
Well, the S&B will step in. We never know what levels they step in, but roughly around 104 is when it tends to get quite aggressive in Euro Swiss, and it gets quite stable. We saw after the Brexit votes and other big vol events, very stable Swiss, thanks to the intervention of the S&B. They've not been in the market from our estimates for quite some time. They haven't needed to be, because we had the ECB normalization trade. The ECB to raise rates, and that would make it easier for S&B because there'll be less Swiss franc appreciation.
But will they raise rates? Because we heard from, someone on the S&B saying actually negative rates work well in Switzerland.
Oh, the S&B, I don't see them raising rates for at least a year or 2, probably 2 or more at this rate. If the global slowdown becomes entrenched, the ECB's hiking program, not this year, is it next year? Big question mark still on that. So the S&B is going to follow the ECB with a big lag, probably 6 months to a year. So that's why it's quite a while before we see the S&B raising rates. But what drives Swiss is risk off. It's not really Swiss problems that drive Swiss. So Italy, the slowdown in Europe, that's seeing renewed demand for Swiss franc here.
But they're worried, the S&B wouldn't move because they're basically worried about upward pressure on Swiss franc, and they're worried about a deflationary kind of environment, right?
Well, yeah, the CPI basket of Switzerland, which is their target, they target CPI, of course, like most of our central banks, 25% of that is imported. So a big component is what happens in Europe, and we're having deflation risks rise in Europe, so we're having deflation risks rise a little bit more in Switzerland.